gap financing is basically where a lender provides a portion of the budget against no fixed sort of contract. It's basically, a little bit more risky in that we're lending against the future sales of those whatever unsold distribution rights there are. So we do a lot more analysis on that part of it because of that additional risk. And that starts way back when with the sales agent themselves, and are they a company that we feel comfortable doing gap financing with? But that fills in a piece of the budget that that you don't have pre-sales for, and it's not covered by a tax credit of some description. But the bank's ability to do gap is up to a maximum of about 20% of the budget. And if there's still not enough money after that to complete the financing, then they need to go out and find an investor and put in some equity or some other source of funding. The value of the unsold rights needs to be at least 200% of that gap amount. So in this example, those rights need to be worth at least $2 million. And the reason we do that is that we set the bar a little higher, knowing that if some of those sales come in, 75% or even 50% of what that estimate is, we're still covered. The problem in today's market is that the variation of what those rights could be worth is much more extreme. We've seen some pretty crazy scenarios, but generally we get it right. Going back to being in business with the right sales agent who has made some pre-sales, and then those pre-sales we use as an indicator, relative to the unsold rights, and we look at it that way.